Welcome to Technical Tuesday. This is Fed Razak, Senior Trading Strategist here at CMTrading. And because we're in the midst of coming out of a recessionary environment that we're currently in, and tomorrow, September 20th, 2023, the Federal Reserve, the FOMC in the United States, will be issuing a very important interest rate decision. I thought to interrupt our regular series that we've been discussing and kind of really breaking down technical analysis and to kind of sideline and to sit and really discuss the FOMC. But before we start, make sure to like, subscribe, and do share to the channel so that you help the channel grow and you share it with like-minded people. So what is the FOMC? What is their purpose? And how would you trade it, or how would I trade it? Okay, so the FOMC is the Federal Reserve, which is really the central bank in the United States, which does what? Well, they control the money supply in the market. Okay, they're an independent body that was set up around Eisenhower's time. Okay, it goes all the way back then because the economy needed to be managed. Okay, the money supply in the market needs to be managed. Money is a commodity just like anything else, and it does have value, and it also does have devaluation of its currency. So the United States set up a central bank, the Federal Reserve, to kind of control the money supply in the market. Now, the Federal Reserve has several ways that it controls the money supply in the market, one of them being issuing bonds to the market or collecting those bonds back. Another one that is most popular is the interest rate decision. Now, this happens several times a year, about 8 times a year. And the real biggest catalyst, okay, what the Fed decides as to what's going to be the interest rates right now is really inflation rate. Now, over the past year, really towards last year, okay, we saw a surge in inflation around the world, but specifically around the United States, which is really the benchmark for everything else, right? And as a result, the FOMC, the Federal Reserve, increased interest rates to lower the devaluation of the dollar. Now, as this is a little bit of mechanics, because there's a lot of things that go into this, a lot of things that are in the pot that the FOMC uses to make this decision, not just inflation rate, but also joblessness, okay? At the same time, they want to increase interest rates too high, and then that will staff off from businesses taking out loans in order to expand their businesses because things are starting to get expensive. Money's starting to get expensive. And as a result, they're less inclined to do what? They're less inclined to hire people, employees. So it's like a very, very careful balance. But the FOMC has been exceedingly aggressive over the past year in increasing interest rates and keeping it at a very high level in order to make sure we don't get like in this complete tornado of a inflationary cycle, okay? It has really been, historically speaking, we haven't seen the inflationary rates that we've jumped over the past year as what we've seen since the 1980s. So for almost 40 years, we kind of kept it in check between all the Federal Reserve chairmen or chairwomen that have been over the year, namely Greenspan, who really set the system, and before that Volcker, but it's really Greenspan who really has been there the most time and, you know, has set the standard as to how they control the money supply into the market, allowing the market to open and allowing the market to subside. And, you know, this has really been a very interesting, I mean, as an observer of the markets and a trader of the markets for over 30 years, I really can appreciate it because I've seen things in the market of what they expect the FOMC, and things were completely different. And, you know, you got to hand it to them. They've done a fantastic job over the past 40 years, kind of keeping the U.S. economy in check, not making it too hot and, you know, too explosive, but at the same time, not, you know, spurring it when it's gotten cold as well. So it's a really very delicate game, okay? Now, when does the FOMC issue this interest rate decision? So it's going to be published at 8 p.m. South African time tomorrow. That's September 20th, 2023. Now, like I said, this happens several times a year, so you'll get other opportunities to view them, okay? Now, as a trader, technically speaking, what should you do? Okay, so here goes. These are a few points that I'd like to highlight for everybody when they're trading the financial markets in this type of environment. And this will kind of cue you in. one thing I'll say before I even start this, if you've never seen an FOMC, a Fed rate decision, don't trade the first time. Just view it. I would even suggest the first 4 times, okay? Kind of like absorb it, because the markets are really trading quite erratically. And that's really because there's knee-jerk reactions, there's overreactions, and there's kind of like, as the dust settles, things are kind of put into check. But these are things that I think, these are a few points that I've seen time and time again that have helped traders when you're trading these type of volatile situations. Now, everybody's expecting it. So there's no hidden thing here. There's nothing like, unexpected. Everybody's expecting this big number. And even if the number is not a surprise, sometimes the market does react to it, okay? So it's really market sensitive to how it reacts. And sometimes you think that there should be any reaction and there isn't a reaction. And sometimes you don't think there should be any reaction and there is a reaction. So it could go both ways. And remember, the markets could go up or down, right? So there's a lot of variables here that can happen. Okay, so number one, all right, is never trade the actual number. Never go into the number with a position. Why do I say this? Well, several reasons. Yes, you may be right, but yes, you may be wrong. Now, I just said before that nobody really knows what to expect. There are sometimes expectations the market's going to go up if the Fed does this, and sometimes it doesn't follow through. So you're left on the lurk. And for that not to happen, okay, because the moves are so extreme, you could really get hurt financially in this type of environment. So my suggestion is don't trade the actual number. Don't go into the actual number with a position, okay? Let the dust settle. And the next one is just really look for that fade opportunity. So I've covered this in Trading the News, major news events, and it's the same thing for FOMC. When there is a major news event, there's usually a reactionary move and a re-reactionary move to that reaction move. And so you have like the market goes up, let's say, and then it kind of dwindles and then just goes right back down, okay? It's a spike and a fade. That's called a fade. Now that happens, I would say, most of the time. Not all the time, but most of the time, okay? And nevertheless, there are people that do get caught up. Sometimes it's a fade and you don't know exactly when to get it. So let the fade actually happen, and then you'll be able to assess. Let that first move happen, and then you'll be able to better to assess whether or not to enter the market or whether or not to, okay? And some of those type of situations that there's a reactionary move and we continue going in that direction, and that's where people could get caught in a fade kind of environment, especially if they're thinking fade, 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 and then they see themselves, making, if they're shorting something, for example, and, they short the top and then start trickling higher, 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 and they don't know why they're losing money, and they're thinking fade, 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 it has to fade, but it isn't fading, and it's hard for them to get out. So just be aware of that. Now, the next one, okay, is just trade something that is most related to the market. Okay, now this is what I mean by that. Okay, if you're looking to trade the euro, Japanese yen at this type of news event, it's completely off. You should be looking to trade, ideally, the bank stocks. Okay, the JP Morgans, the Bank of Americas. Okay, those are the ones that are most affected by the Federal Reserve's interest rate, right? It's the retail banks that are going to have to now set the standard for retail clients. So they're the ones that are affected the most. So you want to look to the thing that is affected most closely to the event to trade it. Now the second one, or even the first one, I would even, do away with the banks. I would jump straight into the Dow Jones minis, okay? Because they are really a representation of New York Stock Exchange stocks that are affected by the interest rates. So for example, trading something like Microsoft or Apple is really irrelevant here, okay? Also, I mean, it's a US stock, but it's not so closely affected to the interest rates per se. Yes, in the global matter of things, they are affected. But in all seriousness, okay, in all sensitivity to the FOMC's rate statement, it's not as correlated. So it's the Dow Jones and the bank stocks that are really the most vital ones. And the last one, don't let your losers get out of hand, okay? I've seen people, unfortunately, give up a good portion of their account in these type of events. And if there's anything you've gotten from my videos, I'm always thinking defense, offense. Defense first, offense, okay? You want to preserve your capital. You want to be sure that you can stay in the game. And the first thing you got to do is to make sure you cut your losses very quickly. creates some tremendous volatility. Volatility equals tremendous opportunity, but it's a double-edged sword. So just make sure that you don't let your losers get out of hand. This is Fed Ray Zach. I want to wish you guys a great trading day. Thank you for joining me for Technical Tuesdays. Just trade responsibly, okay? If there's anything else I could leave you with, that's it. Thank you, and we'll see you here next week.